Hope everyone is doing well. This is going to be a video over July the 20th. And, pretty fascinating past couple days. We broke to the upside. Daily chart, we had a strong breakout yesterday. The bulls got minimum follow through, broke above this high. They did close above the June 28th high. However, probably always in long, they may need one more bar. So we'll see with tomorrow. And overall in the open, we had continuation with yesterday. Market rallied very strong yesterday, went sideways, and then on the open, we continued sideways, broke to the downside, and we reversed up pretty strongly. And, really one thing to point out, we tested the July 8th high during the day. We came close, didn't quite reach it. So I'll just mark that. And you can see right here. Came close to it, but we broke below these lows, and then we had a strong breakout to the upside, and then really a trading range for the rest of the day. So you can call it an opening reversal, you can call it a trend from the open. Most trend from the opens where you do get a strong breakout, and I would still almost call it a trend from the open. I know the first hour went sideways, but it's still pretty close to it. Most of the time you get a trading range on the open, or after the trend from the open for at least a few hours. And we had a strong trend from the open, or let me back up, I'm speaking too quickly. We had consecutive buy climaxes for really the entire day, which greatly increased the odds of at least a few hours of sideways trading. And that sideways trading can come late in the day, or it can come after the first 2 hours of the day. So if you think about it, 50% of the time you can get resumption in the direction of the consecutive climaxes like here, and then you go into sideways trading. So this still met the minimum. So on the open, traders will often look for, at first they're going to assume it's some form of a trading range open until they get some sort of consecutive bull bars or a breakout. So let me kind of back up for a moment. So on the open, we knew the market would go sideways, and typically traders want to see some kind of a trend from the open. So if you look at yesterday, we went sideways, had a bull breakout follow through. That is a strong enough breakout for a second leg, and we kept getting that the whole way up. And by this point, it's consecutive buy climaxes. The odds favored sideways. However, it never really happened. It happened here. We rallied a little bit more, and we rallied at this point. When we broke to the upside, I thought we would have a final flag and that we would test back into here. However, when you get a big bull bar closing like this, let me kind of zoom in a little. When you get a big bull bar like that, that is a problem for the bears. This is a strong breakout. You may get a second leg, and you really don't want to sell the new high because you don't know how high it could go up. So if a trader did sell the high, which they probably shouldn't, you're getting gaps here, and you get that, you've got to get out of the trade. So let's talk about, let me go day by, just kind of bar by bar real quick, even though, you should be in the trading room, especially today because Al went over all this. And he would do a lot better job than I would because he spent over 40 minutes, I believe, talking just about every bar. But first bar, it's a doji and probably going to go sideways. I'm going to speed it up because, again, Al already talked about all this in the trading room. And more sideways, limit order market, tight trading range, probably buyers below, probably sellers above. You may get down to the June 8th high. We broke above it. We may get down to here, consecutive buy climaxes on yesterday, so I'm thinking trading range today. And 3 consecutive bear bars, 1 closing on its low. Reasonable swing short. The market's going to double. It's going to double, triple the range. This is very small. So we could get a strong breakout. So if you're selling, it's a swing buy or it's a swing short. All right, so had to pause this for a second, so I forget where I was at. But point is, it's a reasonable sell below, decent breakout bar, closing below all these bars down here, but big tail. Maybe always in short, consecutive bear bars, probably second leg down, but tail above. So you may find disappointed bears, and if the bears get disappointed, they may get out. There's, again, 50% chance the first breakout fails and reverses. Doji, it's a bull bar, it's a bull reversal bar, but micro channel since this high, probably sellers above. There are plenty of bears who they'd sell this close, they'll scale in higher, get out break even. Other bears will just get out of break even. Some bears, if the market goes down, they think they'll know there's buyers down here, so they'll look to just get out, which is why we went outside up. We went below this low and immediately turned up. Traders that were short, when price went below here and started to reverse up, those traders would certainly exit above this bar. Aggressive bulls will buy, betting on a double bottom. Strong breakout, strong outside up bar, probably at least second leg up, and follow through, probably going higher. Probably will test up here, so swing buy. Low one short, buyers below. I'm going to speed up a little bit. Strong breakout, probably buy the close. It could be a wedge. 1, 2, 3, probably won't be. And another bull breakout, so consecutive bull bars. Odds are we're going higher. 3 consecutive bear bars, and then we got a fourth one, probably buyers below and at least second leg up, which we got right there. So bulls will buy, use a wide stop. What else? And it's buy for any reason. I think the most important thing for people to realize and learn is traders will buy. They'll buy all the way up here. They'll buy above this high, and they're going to use a wide stop. And some will be quick to get out. Some are momentum traders, but others are going to use a wide stop. And they'll be quick to get out and then look to buy lower, or they'll just use a wide stop and, maybe they trade a 30% size position. So if their risk is $100, maybe they risk $20. I'm just giving an easy number. And they'll look to add on lower because they're confident that they don't want to miss this right here. So they could buy and then scalp out if it goes that way. Or, so as I was saying, traders they'll buy all the way up for the simple fact they know they can use a wide stop. If it goes straight up, like they buy here, it goes straight up, they take their profit. And if it pulls back, they don't panic because their stop's wide, and they'll buy more lower. And it gives them two choices. They can get out at the midpoint, somewhere up here, or they can say, yeah, I'm fine with holding for a couple legs. We're going to test the high close, fine by me. And what you'll notice right here is this is break-even traders getting out. Bulls bought this close, scaled in, getting out break even. They're really no different. It's a little different, but it's the same concept as people like this. Al talked about doing this accidentally, but he still did it and managed the trade. He bought here, thought he was out, and it turns out he wasn't out, and he bought more lower, got out break even. Same concept. Now, what people have to realize, though, I don't know if Al did this, but I'm pretty sure he would. He would buy one lot here. So to keep things really simple, one contract here, and he would buy another contract several points lower, which would allow him, he would buy one contract here and then buy 2 contracts. He would double his position, so buy 2 down here for net 3 contracts and be able to get out probably at a better price if I had to guess. So let's go back to today, and this is going to be, again, a short video because Al talked about a lot of this stuff. But anyways, buy the close all the way up here. Traders will scale in. Some traders would get out and then buy again above this bar and, a couple legs up, then get out. Trading range, strong breakout, traders knew the market would go sideways and lead to a trading range. And when you broke above this high, bad follow through, you have a wedge. This is probably a leg in a trading range. So a lot of traders would be hesitant to buy up here. They don't know if it's going to go all the way down here. Plus, this is really climactic and the odds favor a trading range. So when you have a micro channel right here and a bad stop entry buy, traders that bought here would more than likely get out below this bar. And if you bought here, price would not allow you to get out break even on this bar and then immediately turn down really aggressively. If you look at a 1 minute chart, I'll just do it. That's your 1 minute chart. So strong breakout, follow through. And, I wouldn't recommend looking at a 1 minute chart, but it's important if you can kind of visualize it. We went down a lot of points really fast in 2 minutes. So a lot of strength. Strong enough breakout, probably going to get a second leg down, but if you think about it, this breakout here is a lot different than this breakout here. There's probably a 70% chance you're going to get a measured move up. So you buy this close, 70% chance price is going here. And why is that? Well, there's not a lot of overlap, so you're going to get a second leg up. Here, is there a 70% chance you're going to get a second leg down? And let me restate that. 70% chance you're going to get a measured move up, 70% chance you're going to get a measured move down. Probably not. It's a leg in a trading range. So we had a strong rally, second leg up, strong breakout, but look to the left. Here you're closing the bar, you're closing above everything to the right. And while it might be exhaustion, it's probably going to have to go sideways, even if it is. And this is a strong enough surprise you're going to go higher. Here, it's a strong enough surprise you're going to go lower. But you had a lot of bulls that were willing to buy here. So those bulls, they may buy here, and they may buy, in fact, they did. They bought more lower, and what did they do up here? They got out break even. So if you're selling, it's way better. First, you have to use the wide stop, but also it's a lot easier if one can sell and, again, trade like a 20% position and then sell more higher. It gives you a lot more flexibility in terms of you can get out back to low close. And that's why there's partially a tail right here. Some traders, they were buying back shorts. Bulls knew that, so they'd buy at the close and take a small profit. Other bulls, maybe they bought here, realized it was a mistake when it went down, getting out around break even. Some bears will just sell 50% pullback at this bar, saying this is strong enough that we're going to probably go a little bit lower. 3 consecutive bear bars, big tail, another tail. Traders will probably buy the close, and this gap will close, but after 3 consecutive bear bars, might be a minor reversal. And same thing here, sell the closed bears, disappointed, tried to get out break even. Trader that sold here and more here could have gotten out quickly. Most traders would get out above this bar here and sell again higher, maybe below this bar. But some traders will sell here, sell more here, and that's probably close to break even, which you can see it pretty much was, which is why we got a bounce. So traders sell this close, sell more here, 50%, it bounces, traders take a quick profit or a quick scalp. So those are bulls anticipating bears buying back shorts for a bounce. And this pause bar is also a sign that it's a reminder for the bears that this is a bad follow through bar. Yeah, so we were back over here. And I'll have to wrap this up in a few. It's later in the evening and I'm getting kind of tired. And I'm starting to lose my focus thinking about all this. But disappointing second leg down. So it's 3 legs down is where I'm getting at. These tails and these pauses are hesitations. So they're legs. Rally, pause, second leg. Rally, pullback, breakout, second leg, third leg. But more on that later. The more you think about it, it becomes easier to see that. 2-legged pullback or 2-bar reversal. I can barely even speak right now. Bears are going to get out. Bears sold this close, sold more up here, trying to get out at the midpoint of these 2 bars. Some bulls will buy 50%, and we got a couple legs up. And, again, strong breakout. Look to the left. It's probably going to be a trading range. It's a wedge, 1, 2, 3. The bulls that bought this close, they wanted the market to race up. It didn't, so traders are going to be disappointed. They're going to sell out of longs, and the market starts to go sideways. And again, this is different. This is not the same. This right here is not the same as this. So traders aren't buying above bars. They're not buying on highs. They're not buying this high one thinking, well, what a great opportunity to buy. They're thinking, yeah, it's a trading range. This looks good. We may get a couple of legs up, but I don't know. If the bulls are so strong, why couldn't they get a second leg? Something's wrong. And we went sideways into the close. So hope this helps, and take care.